Welcome everyone to another video. We're going to talk more about volatility metrics and how we need to really understand volatility and the various kinds of volatility. We talked a little bit about implied volatility versus historical volatility last time and the interplay between the two, how they're very related, but also how they can diverge. And volatility is very important. When we're selling options, we're really creating that bond proxy, and we need to really understand what we're doing there. We need to respect the direction of volatility. We need to respect the overall environment. Is it getting more volatile? Is it getting less volatile? So these are some of the things we're going to really dive into, because that is understanding these things is going to really help our performance over time, because half of this game is really staying out of bad trades, and the other half is getting into good setups and good trades and good closes, etc. So really, it's a game where you can have a 95% win rate and still not really make any money, because the one or two trades that really go against you every now and then can really undo so much of that good work that you do. So very important to keep in mind that the asymmetrical relationship between volatility and your performance when you're selling leverage is very much something to note. And so that's why we always think about the environment. How do we stay out of trouble, and then look for edge, right? Because it all comes down to edge. So we talked a little bit about this chart here. Well, the whole video is on this chart, so go back and check it out if you haven't watched it already before you continue on with this video, because it's an important foundation for what we're talking about. The gold line is implied volatility. It's looking forward. It's the market's best guesstimate of where movement is going to be going forward. And the blue line is historical volatility, and it's looking backwards. And so that's basically what insurance contracts are. If you're looking at house insurance, if you're looking at car insurance, et cetera, they're just trying to price insurance. What can they base it on? Well, they can base it on history, right? What has behavior been in the past in order to inform how we should price the potential behavior going forward? And that's really the crux of how options are priced, and how that pricing can try to make sense. Now, what we do find is that oftentimes the implied volatility or the option pricing is higher than the underlying risk, and that creates our volatility risk premium. So volatility risk premium is really at the heart of what we're doing as option sellers. Really, we're trying to capture this excess that people are paying for option premiums, excess over the underlying risk, because that is where there's a little bit of edge. And we can see that this edge really does play out over time. Look at this. This is volatility risk premium, which is that positive edge. If it's a positive volatility risk premium, it's positive carry, we also call it. We can see that it's positive above this zero line most of the time in history, going back to 1990. Now this is quarterly, so this is filtering out some of the monthly tails. If I were showing monthly data here, you would see a lot more of these tails below the zero line. And what those mean is where the market movement kind of overpowered the option implied volatility, so the pricing that was there. And that can happen. Global financial crisis, COVID, a number of periods in between. We had some very difficult quarters. And of course, if we put in monthlies, we're going to see a lot more of those. But generally speaking, probably 83% of the time, let's say, give or take, you have this positive volatility risk premium, which is really the basis for what we're doing, right? There are other things involved, but the basic premise of option selling is really that you're kind of, there's delta, there's direction, there's picking, quality, etc. The basis of it, though, is that options tend to be overpriced, which of course makes being long options much trickier, particularly in the shorter term expiries, right? If you want to go long options, I always like to say, give yourself time, go further out. That's another topic for another video, but go further out, give yourself time, get away from that sort of fat part of the theta decay curve. So volatility risk premium, very important. I've had a lot of worries in my life, most of which never happened. Mark Twain. So Mark Twain might have been a very good options seller if he had sort of been around at the time that options existed, because he had this realization that there's a lot of worry out there, and a lot of it under realizes the levels of worry, right? So that's what we say in sort of vol speak. We say the market has under realized implied volatility, right? Under realizing the expectation of volatility, particularly to the downside in something like the S&P 500 index, you have extremely steep downside put skew, which we'll talk about in another video, but that's really kind of a big part of where that edge does come from. A lot of the time, it's there because people are buying insurance, they're hedging portfolios, they're perfectly happy to see that insurance go to zero because that means markets are probably stable or going up. And that's the bigger goal for investors and for portfolio managers who do this for a living and use insurance. So volatility risk premium, very, very key and very pronounced in equity markets. Look at this. You can see that vol risk premium, so that excess that people pay for premiums over and above risk, is quite pronounced. EU equity vol premium, US equity volatility risk premium. Look at it compared to rate vol VRP, to treasury, to commodities, to FX, to credit, et cetera, et cetera. So very, very good reasons for this. And one of them is really what I just talked about is people are insuring their portfolios, right? That's what people do. They get a paycheck, they put a little piece into the market, hopefully, and the portfolio manager hedges the downside. It's as simple as that. There is a sort of captive audience of insurance buyers in the market, tends to skew up the amount that they have to pay because the liquidity providers, the people on the other side of that, counterparties are saying, well, okay, I'm going to sell you insurance, but I'm going to make you pay up a little bit. Typical rule of thumb is if the VIX is 16, realized movement is probably a 14, right? So add a couple points, roughly speaking, right? If the VIX is 15, that means the market is moving at a 13, maybe a 12, somewhere around there. And I'm going to show you in a moment how that can actually really, really differ. So next, let's talk about distribution curve. So don't get PTSD if this takes you back to high school math. This is your probability curve. And in our world, we have this refer to the possibility of movement. So if I sell a 1 standard deviation put or a call on Apple, for example, I'm expecting that 68.2% of the time Apple's going to stay within that parameter, right? Within that strike price by expiry. So 68% of the time, statistically speaking, we are going to be okay with selling that premium. Now, does that mean all of the time? Well, no, 68% isn't 80%, it's not 90%, it's nowhere near 100%. I think that's where some people go a little bit wrong with these expected moves that they hear about. They say, well, Micron is expected to move $12 tomorrow, and how on earth did it move $15? That doesn't make any sense. The expected move was 12. Well, that's expected move, right? That's usually based on around a 1 standard deviation, give or take. And really that is only 68.2% of the time that it's going to do that. Now, we are going to find out in a moment that it actually stays within those expected ranges more frequently than that. That's the good news for option sellers, is that this curve is actually not very accurate in a sense. There are better ways, there are better curves to use for equity markets. But for our purposes today, we can kind of start with this and sort of say, well, we can go out 2 standard deviations, sell a much, much further delta, and we're going to have a 95% chance that we're going to stay within that range, which is great. You're not getting as much premium, but boy, 95% chance, pretty good. And then 3 standard deviations is going to be about 99%. So 99% of the time you sell those strikes, and they are going to be the odds on they're going to go to zero, right? Not always, but the odds are most of the time they're going to go to zero. Now, when they don't go to zero, occasionally selling that tiny delta is going to turn into a disaster. In an August 5th, for example, $1 puts turning to $30. I mean, that kind of thing happens. And if anybody trades zero DTE out there, you know how very, very quickly things can change in that world. So, definitely impossible is not a word in markets. Possible is really, you have to always expect the. Just a reminder, everyone, of the disclaimer. So anything we talk about today is for educational, entertainment, and information purposes only. The market to do what it does. So the reason I bring up this standard deviation is I want to show you what this looks like if you're going to get into a stock like MSTR, because what we're going to find is that 1 standard deviation is about that 16 delta, but it's going to vary based on implied volatility, right? So standard deviation is going to be very different for MSTR, MicroStrategy, which is a Bitcoin complex stock. It trades at 114 implied volatility, which is extremely high, right? Sometimes implieds get a little, quite a bit higher than that. I've seen 350, 400 even in MSTR. But for something, this is consistently above 100 implied vol, which is very, very high for a stock because it's very, very volatile. We don't have to get into why that stock is very volatile, but it's linked to Bitcoin. It's a leverage play on Bitcoin, and so has a one standard deviation strike that is 24% lower. So let's take a look at that. Here's your option chain, and we can see that the price of the stock is $396.50. Well, let's go take a look at our deltas here. As we go down, 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 we find our 15 delta, which is close to our 16 delta, and we can see that this is the 300 strike put. So even though the stock is trading at 396, the 300 strike put is 24% below where the stock is moving for 32 days of life, including weekends. So and holidays and things like that. So that is a pretty distant strike. Now it gets even worse. I mean, I've seen MSTR at 200 vol, so it can get a lot more distant than that. But let's take a look at another stock that isn't nearly as volatile. And that's going to be Apple. So Apple is going to trade at 229.98 here, so 230 basically. Let's go down our option chain. Here's our 14 vol, so that corresponds with a 210 strike. 212 is the next one. So let's say our 16 delta is probably around 211. So that's about 8% lower from where Apple is right now. That's a big difference, isn't it? With MSTR, we had a 24% lower strike for a similar 15, 16 volatility. That's 3 times the distance. So the implied volatility has a very deep impact on what strikes you're using. And that's actually a nice thing, because when we're trading MSTR, we want more room, right? You don't want to sell a 1% out of the money put on MSTR. It'll be there like in 4 minutes. You want to sell something that is more appropriate for this particular name, for the particular volatility in this name. You want your ranges to adjust to the prevailing environment for that particular stock or index or whatever it is. So very, very important consideration is that your standard deviation is going to move around. Now, getting back to this particular issue, we can see that some great data put together by Tasty Trade here. So 68% of the time, our standard deviation, the SPY is supposed to stay within a given range. So we don't have to know exactly what that range is, but at any given time, historically, they've taken this over years and years, this data has come in, and we can see that the actual percentage of the time that it stays within that range, that one standard deviation range, is actually 86%. So they expect it to stay within that range for 68% of the time, but it actually stays within that range 86% of the time. That's a massive difference. And this is really volatility risk premium. How much more are they charging for options than realized movement, meaning the actual tendency for stocks to move around and move through strikes? They're charging more, quite a bit more for SPY. For QQQ, it's 78% of the time, so a little bit less generous, a little bit less of that volatility risk premium, and in the diamonds, very similar to the SPY at 85%. Now we can do the same things for individual stocks. Here's Amazon, 77%, 76% on Goldman, Google 78%, and then IBM, Big Blue, with a nice 85%. So it stays within the expected range 85% of the time. And so really what this does is it kind of gives you an idea that this particular curve is actually not that accurate, right? We know that this isn't accurate. It is something to base things upon, but we know that 68% of the time is actually 85% of the time for the diamonds, 86% of the time for the SPY. So if I sell this strike here, I'm actually going to be threatened less than mathematically we are expected to. And so that's kind of one of the cool things about understanding implied volatility, understanding realized and volatility risk premium, is that we can sort of develop an idea of, well, look, where's that volatility risk premium? And in the next video, I'm going to jump in and I'm going to actually start giving you some cool calculations on how much that volatility risk premium is, how we can slice and dice it, and turn that into some viewpoints on where we should be trading given certain environments. So the next one is really where this all starts to come together. And I hope you guys enjoyed it, and we'll see you then.